Hello and good day. Our topic for today is joint arrangements. At the end of this topic, you are expected to define a joint arrangement and state its characteristics, differentiate joint operation from joint venture, account for joint operations, and describe the accounting requirements for joint ventures. First, let's define joint arrangement. PFRS 11 defines a joint arrangement as an arrangement of which two or more parties have joint control. In this definition, there are two terms that are very important. First is arrangement, specifically contractual arrangement, and the second is joint control. These two terms are very important because they relate to the characteristics of joint arrangement. One of the characteristics of a joint arrangement is that the parties are bound by a contractual arrangement. And this contractual arrangement distinguishes an interest in a joint arrangement from other types of investments, such as investment in equity securities measured at fair value, which is in accordance with PFRS 9, investment in associate, which is in accordance with PAS 28, and investment in subsidiary, which is in accordance with PFRS 3 and PFRS 10. In investment in equity securities measured at fair value, the interest in the voting rights of the investee should be less than 20%. In investment in associate, the interest in voting rights of the investee should be 20% to 50%. In investment in subsidiary, the interest in voting rights of the investee should be 51% to 100%. But in a joint arrangement, the interest in a joint arrangement is contractually agreed. Another characteristic of a joint arrangement is that the contractual arrangement gives two or more of those parties joint control of the arrangement. Joint control is the contractually agreed sharing of control of an arrangement which exists only when decisions about the relevant activities require the unanimous consent of the parties sharing control. Joint control exists when all the parties sharing joint control over the arrangement act collectively or act together in directing the activities that significantly affect the returns of the arrangement. Unanimous consent here means that there must be consent of all the parties sharing control. There are two types of joint arrangements, and they are first, joint operation, and second, joint venture. Joint operation is a joint arrangement whereby the parties that have joint control of the arrangement have rights to the assets and obligations for the liabilities relating to the arrangement. Those parties are called joint operators. On the other hand, joint venture is a joint arrangement whereby the parties that have joint control of the arrangement have rights to the net assets of the arrangement. Those parties are called joint ventures. As you can see, the joint operation and the joint venture differ depending on the rights and obligations of the parties that have joint control of the arrangement. If the parties that have joint control of the arrangement have rights to the assets and obligations for the liabilities, then the joint arrangement is a joint operation. If the parties that have joint control of the arrangement have rights to the net assets of the arrangement, then the joint arrangement is a joint venture. When we say net assets, these refer to the equity. Net assets simply mean the assets after deducting the liabilities. That's why when we say net assets, these refer to the equity. Let us now proceed to the financial reporting by joint operators. In relation to the interest of a joint operator in a joint operation, the joint operator shall recognize the following. First, its assets, including its share of any assets held jointly. Second, its liabilities, including its share of any liabilities incurred jointly. Third, its revenue from the sale of its share of the output arising from the joint operation. Fourth, its share of the revenue from the sale of the output by the joint operation. And fifth, its expenses, including its share of any expenses incurred jointly. In other words, a joint operator shall recognize its own assets, liabilities, income, and expenses, plus its share in the joint operations, assets, liabilities, income, and expenses. Next, accounting for joint operation transactions. Separate accounting records may or may not be required for the joint operation itself, and the financial statements may or may not be prepared for the joint operation. In other words, separate books of accounts, such as journal and ledger, may or may not be used for a joint operation. And financial statements may or may not be used for the joint operation. However, the joint operators may prepare management accounts. They prepare management accounts to assess the performance of the joint operation. The following are considerations in accounting for joint operations. First, no separate records are maintained for the joint operation. And second, separate records are maintained for the joint operation. When no separate records are maintained, the joint operation transactions are recorded in each of the individual books of the joint operators using this joint operation account. This joint operation account is just like income summary account. Observe that those accounts that are on the left side or on the debit side are accounts with normal debit balances. For example, purchases and freight in. These accounts have normal debit balances. Observe that those accounts that are on the right side or on the credit side are accounts with normal credit balances. For example, purchase returns, discounts, and allowances. These accounts have normal credit balances. If the joint operation account has credit balance, it means that there is a profit. If the joint operation account has a debit balance, it means that there is a loss. The unsold merchandise or ending inventory is placed on the credit side to reflect the cost of goods sold. Also, when no separate records are maintained, personal accounts are used. Examples of personal accounts are receivable from a joint operator or payable to a joint operator. One or more joint operators may act as the manager or managers and are usually paid a management fee or management fees. The management fees are treated as expense by the joint operation and as income by the manager. The manager records any asset other than merchandise and any liability he receives or incurs on behalf of the joint operation using regular accounts but labeled as JO. For example, the asset to be recorded by the manager is cash. Cash is not a merchandise, so the manager will record it as joint operation cash or JO cash. Another example, if the asset to be recorded is accounts receivable is not a merchandise. So the manager will record it as JO accounts receivable. Another example, if the liability to be recorded by the manager is accounts payable, then he will record it as JO accounts payable. The manager maintains these accounts in his own books in addition to the joint operation and personal accounts. The joint operation, personal accounts, and other JO accounts are maintained alongside a joint operator's regular accounts, but these are closed when the joint operator prepares its general purpose financial statements. When separate records are maintained, the joint operation transactions are recorded in those separate books in the regular manner, similar to an ordinary business. The joint operators record only their own transactions in their respective books. Accordingly, personal accounts and JO cash or similar accounts are not used. The interest in joint operation is affected by the following: the contributions and investments, costs and expenses paid for the joint operation, and share in profit of joint operation are placed on the left side. The sales and other income received, withdrawals of contributions or investments, and share in loss of joint operation are included on the right side or placed on the right side. Let us now apply the concepts by answering a problem. Small, medium, and large formed a joint operation. The following were the joint operation transactions. A small transferred cash of 100,000 pesos to large, the appointed manager representing a small's contribution. B. Medium contributed inventories worth 120,000 pesos. C. Large contributed cash of 80,000 pesos. D. Large purchased inventories worth 160,000 pesos and paid freight of 20,000 pesos using the cash contributions. E. Large made cash sales of 900,000 pesos. And F. Large paid expenses of 240,000 pesos from the JO cash. All inventories were sold except one-third from largest purchases. Large was charged for the cost of the unsold inventory. The joint operators agreed on the following. Large is entitled to a management fee of 6,000 pesos and a bonus of 15% of profit after management fee and bonus. Any remaining profit or loss is divided equally. No separate records are maintained. Requirements: prepare the journal entries for transactions A to F, compute for the profit after management fee and bonus, and determine the cash settlements to the joint operators. In this problem, no separate records are maintained. Let's answer first requirement letter A. Prepare the journal entries for transactions A to F. Let's start with transaction letter A. A small transferred cash of 100,000 pesos to large. The appointed manager representing a small's contribution. In each of the individual books of the joint operators, magdedebit tayo ng joint operation 100,000 pesos. Except sa books ni Large. Bakit? Large is the appointed manager and cash is not a merchandise. That's why ang ididebit ay JO cash. Recall that the manager records any asset other than merchandise using regular accounts but labeled as JO. Sa books ni Small, mag-credit tayo ng cash 100,000 pesos since Small transferred cash of 100,000 pesos to Large. Sa books ni Medium, mag-credit tayo ng payable to Small 100,000 pesos. Mag-credit tayo ng payable to Small kasi kapag hindi pinush through yung joint operation, ibabalik yung cash kay Small. Ganon din sa books ni Large. Mag-credit din tayo ng payable to Small 100,000 pesos. Next, transaction letter B. Medium contributed inventories worth 120,000 pesos. Again, in each of the individual books of the joint operators, magdedebit tayo ng joint operation. Sa books ni Medium, mag-credit tayo ng inventory 120,000 pesos since Medium contributed inventories worth 120,000 pesos. Sa books ni Small, mag-credit tayo ng payable to Medium 120,000 pesos. Mag-credit tayo ng payable to Medium kasi kapag hindi pinush through yung joint operation, ibabalik yung inventory kay Medium. Ganon din sa books ni Large. Mag-credit din tayo ng payable to Medium 120,000 pesos. Next, transaction letter C, Large contributed cash of 80,000 pesos. In each of the individual books ng joint operators, magdedebit tayo ng joint operation 80,000 pesos except sa books ni Large. Sa books ni Large, ang i-credit natin ay JO cash. In-explain ko na to kanina. Sa books ni Small, mag-credit tayo ng payable to Large 80,000 pesos. Mag-credit tayo ng payable to Large kasi kapag hindi pinush through yung joint operation, ibabalik yung cash kay Large. Ganon din sa books ni Medium. Mag-credit din tayo ng payable to Large 80,000 pesos. Next, transaction letter D, large purchased inventories worth 160,000 pesos and paid freight of 20,000 pesos using the cash contribution. Sa books ni small at medium, there are no entries. There are no entries because the cash used on the purchase and the freight in are already reflected in smalls and mediums books under entries A and C. Sa books naman ni Large, magdedebit tayo ng joint operation 180,000 pesos at magdedebit tayo ng JO cash 180,000 pesos. Next, transaction letter E, large made cash sales of 900,000 pesos. Kapag may cash sales, magkikredit tayo ng joint operation 900,000 pesos in each of the individual books of the joint operators. Sa books ni Large, i-debit natin yung JO cash 900,000 pesos since mayroong cash sales. Sa books naman ni Small at Medium, i-debit natin ang receivable from Large 900,000 pesos. Next, requirement letter F, large paid expenses of 240,000 pesos from the JO cash. Take note that this is out from the JO cash. Large paid expenses out from the JO cash, not out of his own cash. In each of the individual books of the joint operators, magdedebit tayo ng joint operation 240,000 pesos. Sa books ni Large, i-credit natin ang JO cash 240,000 pesos since Large paid the expenses from JO cash. Sa books naman ni Small at Medium, i-credit natin ang receivable from Large 240,000 pesos. The receivable from Large is credited because by paying the expenses out of the JO cash, Large's cash accountability is reduced. Next, let's answer requirement letter B, compute for the profit after management fee and bonus. So, gagamitin natin yung joint operation na T account kanina. Ang gagawin natin, isa-substitute lang natin yung amounts. Ang merchandise contribution ni Medium ay 120,000 pesos. Ang purchases, including freight in na 20,000 pesos ay 180,000 pesos. Again, yung 180,000 pesos dito, included na dyan yung 20,000 na freight in. Ang expenses ay 240,000 pesos. Ang sales ay 900,000 pesos at ang unsold merchandise ay 60,000 pesos. Paano na-compute yung 60,000 pesos? Sinabi sa problem na all inventories were sold except 1/3 from largest purchases. So, 160,000 pesos na purchases plus 20,000 pesos na freight in times 1/3, that is equal to 60,000 pesos. At yan yung unsold merchandise. As you can see, mas malaki yung amounts sa credit side kaysa sa debit side. So there's a credit balance of 420,000 pesos. As I said earlier, kapag credit ang balanse ng joint operation, if the joint operation has a credit balance, it means that there is a profit. Specifically, a profit before fee and bonus. Here, the profit before fee and bonus is 420,000 pesos. Since ang requirement ay profit after management fee and bonus, kailangan pa nating i-deduct yung management fee and bonus. Ang profit before management fee and bonus ay 420,000 pesos. Sa problem, sinabi na si Large ay entitled sa management fee na 6,000 pesos. So, i-deduct natin yung 6,000 pesos. Next, let's compute for the bonus. Sinabi sa problem na si Large ay entitled sa bonus na 15% of profit after management fee and bonus. 420,000 pesos minus 6,000 pesos, that is equal to 414,000 pesos profit after management fee but before bonus. Para makompute yung bonus, kailangan natin gamitin yung formula na B is equal to P minus P over 1 plus BR. P here is the profit after management fee but before bonus. And BR is equal or stands for bonus rate. So let's substitute the amounts and the percentage. B is equal to 414,000 pesos minus 414,000 pesos divided by 1.15. So the bonus is equal to 54,000 pesos. At this point, since na-compute na natin yung bonus ni Large, pwede na natin makompute yung profit after management fee and bonus. Ang profit before management fee and bonus ay 420,000 pesos. Ang management fee ni Large ay 6,000 pesos at ang bonus ni Large ay 54,000 pesos. 420,000 pesos minus 6,000 pesos minus 54,000 pesos, that is equal to profit after management fee and bonus of 360,000 pesos. So the answer in requirement letter B is 360,000 pesos. Next, let's answer requirement letter C, determine the cash settlements to the joint operators. Ang step 1 ay i-allocate natin yung profit or loss. Ang profit before fee and bonus ay 420,000 pesos. Ang management fee ni Large ay 6,000 pesos at ang bonus ni Large ay 54,000 pesos. So, ang natitirang profit ay 360,000 pesos. 420,000 pesos minus 6,000 pesos minus 54,000 pesos, that is equal to 360,000 pesos. Sinabi sa problem na any remaining profit or loss is divided equally. That's why kailangan nating i-divide yung 360,000 pesos sa 3. 360,000 pesos divided by 3, that is equal to 120,000 pesos. Therefore, 120,000 pesos is allocated to each joint operator. So after allocation, the share in the profit of small is 120,000 pesos. The share in the profit of medium is 120,000 pesos. And the share in the profit of large is 180,000 pesos. All in all, that is equal to 420,000 pesos na profit before fee and bonus. Ang step 2 ay gagawa tayo ng T accounts using joint operation. So, ang gagamitin natin para makompute yung cash settlement ay yung joint operation account. Dito sa joint operation account, ire-reflect natin yung net contributions ng joint operators at yung share in profit nila sa joint operation. Ang contribution ni Small ay 100,000 pesos. That is a cash contribution. At ang share niya doon sa profit ay 120,000 pesos. So that means Small will receive 220,000 pesos. Ang contribution ni Medium ay 120,000 pesos. Medium contributed inventories worth 120,000 pesos. Ang share niya sa profit ay 120,000 pesos. So, Medium will receive 240,000 pesos. Ang contribution ni Large ay 80,000 pesos. That is a cash contribution. At ang share niya sa profit ay 180,000 pesos. Take note, sinabi sa problem na Large was charged for the cost of inventory unsold. Or Large was charged for the cost of the unsold inventory. So, kailangan pa nating i-deduct yung unsold inventory na 60,000 pesos. Ito yung na-compute natin kanina. 80,000 pesos plus 180,000 pesos minus 60,000 pesos. That is equal to 200,000 pesos. Therefore, in the settlement, Large pays Small 220,000 pesos and Medium 240,000 pesos and retains the remaining 200,000 pesos JO cash.